Hi, I'm Ross from Coombsmith 150 Group Property Accountants. I'm just going to go through two quick little examples of how you can work with the new rules and yeah, two opportunities, I suppose, where you can do something where maybe you think that you can't. So I'm just going to share my screen and yeah, we'll start looking at, we've got my favorite characters, Jack and Jill, who've got an investment property. So they're in a different situation. Jack, huge income, 300,000 income. Jill, very small income, 15,000. And they've also got 5 children. So yeah, obviously from the 1st of April, we're looking at Jack going into the 39% tax bracket. Jill, 15,000, she's only on the 17.5% tax bracket. So there's some big opportunities there. We ideally want the income going to Jill and not to Jack. So bring on the first example. We've got a rental that's in Jack's name. It's purchased 1st of September 2019. So obviously that's within the 5-year bright line. And so obviously in a normal situation, we would be caught by the 5-year bright line. The big thing from this example is never give up. The picture might be a little bit blurry, but there's always opportunities, there's always things that you can do. And even though on the surface of this, it might seem like there's no opportunity, there's nothing you can do, it's worth having a proper meeting with me, going through your situation. How are you structured? Can we change it? If you've got a rental property like this in Jack's name, can we actually change it around? And rather than just jumping to the conclusion that you're caught by the 5-year bright line, maybe there's some opportunities there, and in certain circumstances there are. So yeah, definitely worth having a meeting with me or someone like me. Yeah, our main competitor is GRA, Gilligan Rowan Associates. Unfortunately, they're also very good. But yeah, to me, worth talking to a true property accountant like us or GRA. If you've got shareholding, say you've got an LTC that owns this rental property and Jack has 99% and Jill has 1%. Again, big opportunity and worth getting some expert advice. And yeah, just don't presume that the only option is you can't do anything, because if you change shareholding, you're going to trigger a taxable sale. You're going to end up with a big taxable gain, which none of us want. There is some other opportunities, is worth exploring it a little bit further. So if you could do this, if we could restructure it, what could we do if we had a completely open, open example? We could do whatever we wanted and not trigger a tax. What would we do? So say there's $20,000 of taxable profit, and you'll see in one of my next examples that's going to become pretty common once interest deductions disappear. So at the moment, we've got Jack. He's earning 300,000. He's taxed at 39%, 7,800 off tax. That's a big amount. Say if we could restructure this to a trust, just for example, and yeah, I'm not saying you can, but yeah, if we could, 5 children, say they're all under 16. So that means we can only allocate them $1,000 each. So basically 5,000 to the children is going to be tax-free income, no tax. Then the remaining 15,000 we allocate to Jill. She's only taxed at 17.5%, so 2,625 tax. 7,800 if we leave it how it is, 2,625 if we could restructure it. Looking at saving about $5,000 per year, which is huge. So what I'm saying with this is, yeah, don't give up. Never give up. Yeah, there is some opportunities and there is some ways that we can actually keep this so it's 5-year bright line. Keep it so it's the old interest rules, even though they're going to get phased out over 4 years, and not trigger a taxable sale. So in some situations, it is worth getting through it. And to me, these new interest rules, it's always worth having a meeting with me, going through, is there something we can structure smarter like these examples? Is there something else we can do? So our next example, option 2, we've purchased a property on the 1st of August 2017. So that's outside of Brightline rules. It's in the 2-year Brightline rules. 2 years has passed. It means from a Brightline point of view, we can sell it. So it doesn't really matter what entity it's in. The next thing we need to do is think, what about other tax provisions? So Brightline is only one way that we can be taxed. And if you look through some of my other videos, you'll see others. But examples, if you subdivided, it might be caught by subdivision rules. If you're a trader, you might be tainted or it might be taxable. Yeah, if you are a builder, you could be subject to builder rules. So there's lots of other ways that you can be taxed. So don't just presume that you're outside Brightline, hey, this is awesome. You could find that there's actually another way that you're getting taxed. So check those first. Then what we look at is the cost versus the benefit. So what we're obviously thinking is, well, another thing, we want a commercial reason. We don't just want to do this for tax, because then it looks like tax avoidance. So ideally, we want some other reason for that. And that's where I can help with potentially what the commercial reasons are. But say if we could restructure and did want to, 10-year Brightline. Boo. None of us are too excited about that. No interest from the 1st of October 21. Again, not a good thing. And we're straight away thinking, hey, this restructure is not going to work. This is not going to make sense. But on the plus side, we could utilize a much better structure, as I've already shown earlier on. And say, for example, we're just going to give all the income for Jill, for example, if we could do that. So in that case, it's worth just working through what is the cost, what is the benefit. Obviously, the other option is just leave it at how it is. So for example, it might be all the profit might be going to Jack at 39%. It might be in his name. It might be an LTC owned by Jack. So at the moment, we're looking at potentially leaving it how it is, or maybe doing a restructure. And like I say, these things are looking scary, but it's worth actually looking at it. Are you going to keep it for 10 years or not, or more? And that is a big call. It's a long term. But if you've just done a brand new or newish property, it's awesome return, it's going really well. Are you going to keep it long term? So it's worth starting to look at that equation. So yeah, what we do is look at the general profit. So this property, 37,000 income, 28,000 of expenses, making $8,000. We've then got some big chattels. We've then got, about 2,000 tax to pay. 2,000 taxable income, about 800 tax to pay. Or when the interest rules disappear, so when you take away that interest down to zero, profit jumps up to 26,000, less chattels depreciation, you'd be 20,000 taxable profit. You're looking at 7,800 tax to pay, which was the example I used before. So what's the two different scenarios? So if we just leave that how it is, we've got a cash profit of about $8,000 over the next 10 years with me, based on conservative predictions, looking at interest rates going up to 4% over 10 years, looking at rent slowly going up, but all your other expenses slowly going up, and paying tax at 39% because this is somehow owned by Jack. Over the next 10 years, I've got this property costing us $50,000. Old rules, it was making 31. So it's a big change, $87,000 extra tax. Well, if we actually restructured it, we would get no interest from the 1st of October 21, which sounds horrible. But what we could do is if we could allocate all the income to Jill legitimately and have a legitimate reason for that, that drops our cash loss over 10 years from 50,000 down to 8,600. So our extra tax is dropped from 87,000 to 44. So obviously there's about a $40,000 difference there. So even though it sounds hideous, transferring to a new entity, restarting the Brightline rules, losing interest from the 1st of October 2021, in this example, it actually makes sense. There's about a $40,000 benefit from doing it. So really worthwhile just working through that cost and benefit, thinking, just keeping your mind open, looking through the different options. If you're a real long-term hold investor, potentially you could look at a structure like that. So my mind, always worth getting that expert advice and having a chat, having a meeting, going through your options. Also worth going through with a financial advisor, and we've got some great options in the link below. Having a meeting and just going through, do you have a good buffer? Are your loans set up in the best possible way? Be proactive. What happens if the government brings in scrapping or interest only loans? So rather than being behind all the time, start getting ahead. And yeah, that's just a completely free meeting. So to me, worth talking to one of our advisors, have that free meeting, worth having a meeting with me or someone like myself, a real property expert like GRA or myself, and just going through what are your options, what you can do. So hopefully you've really enjoyed that. Hopefully you've got a couple of different ideas out of it. And yeah, maybe you haven't just given up hope just yet. And yeah, maybe there is some different options that can work for you. So thank you very much.